Yo, what's going on, everybody? It's Friday, October 14th, tax day on Monday. Yeah, that sucks, and that's the reason why we're seeing this market pull back. I mean, we were really close, really close to having that whole entire September tax drain replaced. I mean, we got up to within 13 billion. Remember, it was 155 billion drain. And we had all of it except 13 billion recovered. And that's why the market started to come back this week. And yesterday, a big up move. And then boom. And I've been telling you, we're going to get hit with this drain again, unfortunately. But it's not going to be as big as the September tax drain. But still, probably going to see new lows, marginal new lows. And then I think things are going to start looking a lot better for the rest of the year. What else do I want to say? Oh, yeah, there was an article. I saw an article on a blog, Zero Hedge, talking about a dollar squeeze and a panic because now, and I told you this yesterday, that those Fed swap lines, those Forex swap lines, I did a whole video on this yesterday. They're up to 6.5 billion and like 6.3 billion of that went to the Swiss National Bank. I told you that yesterday. And that's, I believe that's allocated for Credit Suisse. And so, like, as usual with all these articles that we see, it's always framed in a very scary, negative way, okay? Everything, particularly on that blog, on Zero Hedge. Everything you see on there is framed constantly in a scary, incredibly dire way. And that's unfortunate. It may be good for them because, it gets people talking, it gets people reading. It may be a clever hook to get viewers and readers. Great. But I mean, I think I did a video the other day saying if you want to dumb yourself down, okay, if you want to get stupid, and I think a lot of you are very intelligent. I see by the comments, I see by the questions. It's interesting because the comments I'm getting on this channel are way different than the comments I used to get like years ago. And I think that just speaks to the quality of you guys, the viewers now. And I appreciate that. I want you to know. But, as intelligent as you are, if you read that stuff and if you watch, CNBC and Fox Business and these shows, I mean, and it's not a criticism of you, but you're going to get dumbed down because it's just this incessant barrage of negativity, and even things that are not negative or even neutral, they are construed or framed in a way as being negative and dire and terrible. Now, I'm not saying the Swiss National Bank going to the Fed for $6 billion to help out, and I don't know if we can call it a bailout, but I don't know if that's necessarily a good thing, a positive thing. I'm not saying it, but I think that it's very important to keep these things in perspective. And now, all of you, at least those of you who watched my video yesterday, you have perspective. Because as big as 6.5 billion is, 6.3 billion was taken by the Swiss National Bank and about 300 million taken by the ECB. As big as 6.5 billion is, especially compared to recently, we've been running like 160 million outstanding, 200 million outstanding, and then all of a sudden 6.5 billion. That's a big jump, right? But by comparison, I showed you this yesterday, if you go back to May 2020 in the pandemic, the Fed had to extend 450 billion of these swap lines. And then if you go back to December 2008 with the Lehman situation, The Fed had to extend nearly $600 billion. $600 billion, 100 times more than what's happening right now. So as bad as you want to call it with this 6.5 billion that happened this week, it was 100 times worse in 2008, just to put that in perspective, okay? Again, I'm not saying it's a great thing that Credit Suisse is getting squeezed, but you know, sometimes banks fail, and I'm not certain that Credit Suisse is going to fail, but I'm just saying, like, it happens sometimes, and there's mechanisms to deal with that. And I even gave you an example, you know, back in the financial crash of 2008, where they basically allowed Wachovia to fail, and it wasn't even insolvent. So that's just bad management of the system, and you know, bad management of the system was not something unique to the FDIC. I mean, it also it applies to the Fed as far as I'm concerned right now, but that's a whole other discussion. I'm not going to get into that. So it's really important to keep these things in perspective. Like, everybody's freaking out. You read that headline, oh my God, the Fed had to give SNB, Swiss National Bank, $6.5 billion or $6.3 billion. Yeah, well, in 2008, they had to dole out 100 times more than that. I mean, think about that, all right? I think that puts it in perspective. Anyway, one of you asked me a comment, Mike, can you please explain what are repos? Sure, I'll explain it. A repo is short for repurchase agreement. You also have reverse repos or repurchase agreements. And basically what these are short-term asset swaps, okay? Some people might call them a short-term loan. I would say a better characterization or definition would be a short-term asset swap. It's where, you know, two banks or the Fed and a bank enter into an agreement where one of them will give cash in exchange for securities, usually government securities, because let's say one entity needs the securities as collateral. Let's call the securities now, instead of securities, let's call it collateral. So it's an exchange of cash for collateral on a short-term basis. All right, they could be a couple of days, they could be a week, there's a term, but they're basically short-term exchanges of assets. And what we have seen recently, actually, I'd say in the last 20 months or so, you know, going back to March 2021, when the Fed set up the reverse repo. So let's go. First, let me break down a repo. Is a repurchase agreement. And that's where, like, a bank or an entity will give collateral to another bank or another financial entity in exchange for cash, with the promise to repurchase that collateral back at a later date at an agreed upon interest rate. Okay, that's a repurchase agreement. A reverse repurchase agreement is where the cash is given in exchange for the collateral. Okay, so in the repo, in the repurchase, the bank wants the collateral. Okay, and they're given the cash. I mean, the bank in a repurchase gets a little confusing. In a repurchase, the bank will give its collateral in exchange for cash. You could almost think of that like a short-term loan, right? They want the cash. They're giving some other entity the collateral, and then they'll buy back the collateral, and that'll pay back the cash at a future date. All right. So, and a reverse repo is the opposite of that, where they want the collateral. Okay, I'm sorry. It's crazy, man. Yeah, they want the collateral, and they give the cash. In other words, they have too much cash and not enough collateral. So they want the cash, they borrow the cash, and they give the collateral. If I didn't screw that up, I don't know. I think you got the idea. So anyway, what has been happening in over the last like 20 months when the Fed set up this reverse repo facility, because the banks were getting loaded up with deposits and reserves. That's because we had, in 2021, record amounts of government spending. Remember, when the government spends, it adds reserves to the system. Remember, I was talking about that, the bathtub analogy, right? The bathtub's filling up. It's going to overflow. You got too much reserves. And what was happening as a consequence of this, that banks were running into regulatory limits, okay? They had so much reserves, which are assets, that in order to keep all those reserves, they had to raise more capital, or they had to get rid of other assets, okay? Or they had to slow down the growth of other assets, let's say like loans. So the Fed said, okay, we'll set up this thing where you can give us your deposits in this reverse repo facility, and we'll exchange that for collateral, for government securities, all right? And this will keep you under that threshold of the leverage ratio. That's what they were running up against. They were running up against the supplemental leverage ratio. So this is what has been going on. And one of the reasons for this kind of predicament that the banks were in, I mentioned the fact that government spending was at a record, so necessarily there was, reserves building up. But at the same time, the Fed was engaging in these asset purchases every month. Remember? They were buying assets every month. What was it, like 120 billion? I forget what it was, but every month they were doing like 120 billion of QE. So the Fed and the government were adding reserves, like filling up the water in that bathtub, to the point where the banks, they had to take that off their balance sheets. Otherwise, they're up against these regulatory limits where they would have had to raise more capital, or slowed down, or maybe even stopped lending or liquidated other assets. So the Fed set up that facility to allow them to move deposits off of their books into that reverse repo facility. So the reverse repo, in this case, the Fed was taking their cash and exchanging it for securities. All right? That's what it is. So let's go over it again. In a repurchase agreement, a bank will give its securities in exchange for cash. All right, that's like a short-term loan with the promise to buy the securities back at an agreed-upon date and interest. All right, they're giving their securities in exchange for cash. That's a repo, a repurchase agreement. And in a reverse repurchase agreement, all right, they're giving cash to some other institution and taking their securities as collateral, taking their collateral, and that other institution, whether it's the Fed or another bank, will at some later date buy back that collateral. Okay, that's the reverse repo. I don't know, when I said it before, maybe I messed everything up, but that's what it is. So a repo, a repurchase agreement, is when they give the collateral and they take the cash, like a short-term loan, all right? A reverse repo is when they take the collateral and they lend the cash to somebody else and they're holding the collateral, okay? That's the way it is. That's how it works. And the Fed set up the reverse repo in order to help the banks take some of that cash off their books, because otherwise it just kept piling up and piling up to the point where they would have had to raise more capital, because they have capital requirements based on the amount of assets they hold. Okay, so when reserves increase through, Fed QE and government spending, reserves build up, like I've been talking about in the banking system. What the Fed could have done instead of this, crazy machinations of let's set up this new facility, so we'll take some of your cash because we're putting in so much cash. They could have stopped the QE and gone to QT, quantitative tightening, which is literally helping to reduce reserve balances, or they just could have suspended that regulatory rule, which they did in the pandemic. They suspended that, where they said, okay, we won't count reserves in the calculation of the leverage ratio. So you're going to be fine. This is a thing that's crazy. Is like they set up these rules, then they engage in policy that puts the banks puts the whole financial system in a situation where they're, in violation of their own rules, of the Fed's own rules. You have a regulator, which is the Fed, right? Think about this, how crazy this is. You have the main regulator of the financial system, the Federal Reserve, sets the rules by which banks and financial institutions can operate. Okay, these are the rules. If you want to be a bank, you got to follow our rules. Otherwise, you don't get a charter, you can't be a bank. Okay, we're going to follow your rules. But now the Fed says, okay, I'm going to do all this other stuff, and it's going to put you in violation of our rules, and you didn't do anything wrong. It's what we're doing now that's going to put you in violation of our own rules. Come on, folks, how crazy and stupid is that? But that's what goes on. So you see why I say these people are they're a bunch of idiots. I mean, how do you have a system like that where you are, the setter of conditions? You determine and enforce conditions which everybody has to comply with, or else you can't operate. And then you engage in things that puts everybody in non-compliance of those conditions. I mean, come on, it's ridiculous. It's completely ridiculous, right? But that's what goes on. Anyway, that's it. It's Friday. Relax, everyone. We're getting close. We're getting close. All right. Have a nice weekend. Bye.